an extension to the public choice theory. There are what are also called political business cycles. And political business cycle theory basically states the economics books talk a lot about business cycles. They don't talk about political business cycles. And the political business cycle basically states, you have your business cycle, basically states presidential elections. Basically states that around presidential elections, there are business cycles. And the theory basically states that 2 years leading up to a presidential election, the economy gets overstimulated. Through accommodative, monetary, and fiscal policy. Now, the theory states that the Fed is not going to raise interest rates during an election year. So they'll keep interest rates low and overstimulate the economy. So on the monetary side, we'll have low interest rates. And what do low interest rates do to asset prices? They drive them up. So they could actually lead to asset price bubbles. On the fiscal policy side, since elected officials want to retain, under public choice theory, want to retain their leadership and power, they will maintain and they will also initiate policy that will create and retain jobs. So they will put into place stimulative fiscal policies to create jobs. What happens if you create jobs when the unemployment rate has already bottomed out? When the unemployment rate is already at its structural low, when you have structural unemployment at its all-time low, and you're creating or retaining more jobs, what happens to wages?
They go down.
They go up.
Oh, really? Why would wages go up?
Because there's not enough labor in the labor market. The labor market is already at full employment. And through fiscal policy stimulus, they are creating more jobs, driving the unemployment rate even lower. Well, if there's not enough workers, are you going to pay workers more or less? When there's a scarcity of labor, you pay more. So wages go up, right? And then what happens to prices? What happens to inflation? When wages go up, inflation goes up. Right? If people have more money, and more money you're chasing too few goods, that's going to create inflation. So you have monetary and fiscal overstimulus that's occurring 2 years prior to the elections. Once the elections are over, the Federal Reserve, because of the inflation and the overstimulus, starts to raise rates. Starts to raise interest rates to try to control inflation. And now that the politicians have already retained their position in leadership, they can start to eliminate the policies and eliminate the jobs. Start cutting back. Start firing people and getting rid of the policies. Because that's all they were doing, was trying to buy the votes through the Jobs Acts, by creating jobs. And then usually by 2 years after the election, because when the Fed starts to raise interest rates in year 1, it usually takes another year because there's a lag effect. The job cuts on the fiscal side are immediate. Monetary policy impacts the economy with a lag of 1 year. So when the Fed starts to raise interest rates 1 year after the election, it's usually the economy is in a recession. If that's the case, then when was the presidential election? 2016. So the Fed will probably start to raise rates, and the fiscal policy makers will probably start to cut budgets over the next year. We will probably, and it's 2017, and by 2018, we will probably be in a recession, using political business cycle theory. Okay. Unorthodox monetary policy. Why is it important to understand negative interest rates? Are interest rates low right now?
Yes.
Zero interest rate policy. Negative interest rate policy. If you look at the yield curve, so they go something like this. Their historical yield curves were like that. So we're basically at a zero bound on interest rates on government securities at 5 years or less. If we fall into a recession, do you think the Federal Reserve will initiate negative interest rate policy to stimulate the economy? Probably. It's already been done in Europe, and it's already been done in Japan. We're already at zero interest rates. You can't lower interest rates through buying bonds. We've already done it. So if we fall into a recession, the only other option from a monetary policy standpoint is to initiate negative interest rate policy. So what's the implications and ramifications associated with negative interest rate policy? Well, if you go to the calculations, we went through this, figure out the cost of capital, the cost of the debt, and the cost of the equity. What's the first variable in the two models? What is it? Risk-free rate. Are yield curves considered risk-free rates?
Yes.
Yes. Tell me more about the equation. We're trying to come up with the expected return on the debt or the cost of the debt. What's the model?
Yeah, risk premiums.
We start asking the risk premiums. And what are the risk premiums? Just give me 3.
Maturity, liquidity, default,
And then when we're calculating the cost of the equity, what model do we use? Yeah, the capital asset pricing model.
Cap N,
Yeah, and give me the equation for that.
so beta,
Okay, times, yeah, return to the market
minus risk free.
minus risk free. Okay. So you can see that in each one of the models, to determine the cost of the debt and the cost of the equity, or the expected return on the debt, or the expected return on the equity, the very first variable in there is the risk-free rate. So if the risk-free rate turns negative, what happens to the cost of the debt and cost of the equity, or the expected return on the debt, or expected return on the equity? What happens?
Well, the debt would be
It
cheaper.
goes down. Yeah, it goes down. Okay. So if we're trying to value a bond, and let's say this is a perpetuity bond, if the risk-free rate turns negative and the cost of the debt or expected return on the debt goes down, what happens to valuations? They go up. And if the risk-free rate goes deep into negative territory, what happens to the cost of the debt and the expected return on the debt? If the risk-free rate goes down a lot, what happens to the cost of the debt and the expected return on the debt? It goes down a lot.
It's gonna create asset.
You got it. Creates asset price bubbles in the bond market. Now in the stock market, maybe we use cash flow T+1, this could be earnings per share easily. We use the capital asset pricing model to figure out the cost of the equity, and we'll just use a perpetuity model, again, to keep it simple, to get the value of the equity. Well, if risk-free rates are extremely negative, what happens to the cost of the equity and the expected return on the equity? It goes down. If the risk-free rate turns really negative, what happens to the cost and the expected return on the equity? It goes down a lot. And if this goes down a lot, what happens to the value of the equity? It goes up a lot and creates asset price bubbles. So what happens when the Fed later on decides to normalize starts to normalize rates and decides to increase interest rates and shifts the yield curve up? What happens when the risk-free rates turn positive and start to rise significantly? What happens to the cost and expected return on the debt and cost and expected return on the equity? It goes up a lot, right? And if the cost of the debt goes up a lot, what happens to asset prices? What happens to bond prices? They go down a lot. And if the cost of the equity goes up and goes up a lot, what happens to stock prices? They go down a lot. That's the popping of the bubble. So basically, the importance of negative interest rate policy and unorthodox monetary policy is the potential manifestation of asset price bubbles and financial market asset price collapses when rates start to normalize. Will investors be hurt if that happens? Yep, because they hold stocks and they hold bonds. Will financial institutions be hurt?
Yes.
Yeah, because they hold a lot of bonds on their balance sheets. Can banks make money in a negative interest rate environment?
Yeah,
How would they do that?
the lower cost of capital.
Yes, but they have to pay depositors. Depositors, would you be willing to take a negative interest rate on your deposits at a bank? No. So you got liabilities, right, that you have to pay some kind of interest to the depositors. And on your asset side, you are buying bonds that are giving you negative yields. Now, what's happening to your spread? You're paying out here and you're getting negative here. Is that going to affect the bank? Yeah. Are you going to deposit money at a bank with negative deposits?
No.
Negative rates? No. Will the profitability of the bank be impaired if they have to pay depositors and they have to buy bonds that are yielding negative?
Yeah.
So negative interest rates will create disintermediation from the banking system. The money will go out. People will not put money at the banks, and the banks will not loan the money out to borrowers, like businesses and people who want to buy real estate. So you will get disintermediation. So you want to write that down. Disintermediation from the banking
Can
system.
you write that down, please?
Yeah.
Thank you.
You get disintermediation. The money is going out from the banks. The banks don't have the money to lend. Is that going to affect the economy? Yep. Yep, because there won't be credit available in the economy, or less credit in the economy. And if the bank has to pay out to depositors and they're getting negative yields, what's that going to do to their profit margin? Yep. So the profit margins are going to shrink. And if the profit margins shrink, what happens to the bank stock price? Stock prices go down. And if the stock prices go down, what happens to the cost of the equity? The cost of capital. So if we have, the cash flow, P+1 divided by the value is going to give us the cost of the equity. If the value of the stock goes down, what happens to the cost of the equity? Goes up. If the stock prices are going down, what's happening to bond prices for the company? Would you be, if you're selling the stock, if you don't think that the profitability of the bank is going to be strong, or are you going to buy their bonds and sell their stock? Or are you going to sell their stock too? If their margins are shrinking and their earnings are falling, they may not be able to pay the bond interest. They may default on the bond. Are you going to keep the bonds? No, you're probably going to sell the bonds. And what happens to the cost of the debt? Coupon over value of the bond is going to give you the cost of the debt. What happens if the value of the bonds go down? What happens to the cost of the debt? It's going to go up. So the bank's going to get squeezed. The bank's going to get squeezed. And if the bonds, if the stocks go down significantly more than the bonds, we know our accounting people, assets and liabilities, we got short-term bonds, medium-term bonds, long-term bonds, and we got owner's equity. Well, if the value of these are going down because the asset prices are going down, would you have to put up more equity in the firm? So the banks could potentially become undercapitalized and may eventually lead to a bailout, like they did in 2008, 9, and 10. So negative interest rates are extremely dangerous. Extremely dangerous. So we could be going into a negative interest rate environment. Let's talk about quantity theory of money.
And negative interest rates only has to do with interest rates on lending and things, right? It's not like affecting the interest rate I'm paying on my credit card.
It could.
Well, then-
The Fed prints money,
Yeah.
okay? And goes into the open market and starts buying bonds. Drives up bond prices and drives interest rates down. If the Federal Reserve wants to go to negative interest rates, they will be paying really high prices for bonds to drive interest rates negative. And under the quantitative easing that's being recommended, is not only will they buy U.S. Treasury bonds, but they'll also buy corporate bonds and corporate stock.
And what's the problem with having negative interest rates on your credit card? Because that's kind of sounding good, but I'm
Why
sure.
would you consume and use your credit card if you knew you were going to be laid off tomorrow?
No, but if, I mean, I have debt on a credit card now. If it suddenly went to a negative interest rate.
No, there's no way that your credit card will ever go negative because you have credit risk.
Okay, so it won't.
Negative interest rates is not at the consumer level, it's monetary policy by the Fed that's printing money to buy bonds, to drive up bond prices so high that it drives down interest rates negative to try to stimulate the economy because the cost of capital is so cheap. But even at negative interest rates, people are not going to borrow because they don't know if they're going to have enough earnings or enough income to pay off the debt. So at any interest rate, people will not borrow, and that is called the liquidity trap. And Keynes talked about the liquidity trap. In the Depression, in the 1930s, interest rates were extremely low, but nobody was borrowing. Because corporations were scared. They weren't spending, they weren't investing, consumers weren't consuming, because there was a lot of job layoffs. So interest rates can be zero or negative and people still won't consume and they won't borrow. It won't stimulate the economy. You're in what is called the liquidity trap. So maybe you can benefit from low credit card interest rates, but you have to have an income to support the debt to be able to pay off the interest on the credit card. And some people, no matter how low the interest rates are not going to rack up leverage and rack up debt because they know that they may not have a job or the profits of their earnings later on to be able to pay off the debt.
Don't credit cards debt go up when the economy is slow?
No.
I thought because people don't have cash in hand, so they're more forced to put things on credit.
The only reason why credit card rates would go up in a recession when interest rates are really low is because the default rates on the credit cards, people are defaulting and not paying their credit cards or paying off their loans because they don't have the income to pay off the credit cards or the mortgages. Corporations do not have the money to pay off the bonds. So the bonds will go into default and that will cause interest rates to go up. And that's what happened during the financial crisis. The financial crisis interest rates were extremely low, but bonds were defaulting constantly and the spreads on the bonds went through the roof. So it becomes counterproductive and counter-stimulative. Okay. All right. Any other questions? Let's do quantity theory of money. Can somebody give me the quantity theory of money equations? Can somebody give me the quantity theory of money equation?
QPM equals GR
No, what's the equation?
equals GR
GR.
times I.
Can you tell me what they are?
Growth.
In what?
GDP.
GDP. Okay. Are we talking about real or nominal GDP? we talking about real or nominal GDP? What is it? Nominal or real? Okay, what's the equation? Give me the equation and we'll go back.
That's inflation.
That's the inflation rate. Okay.
Equals
Equals what?
velocity.
Velocity of money.
Times.
What is it?
MS.
What is it?
Money multiplier.
What is it?
Money multiplier.
Monetary supply of
What is it?
supply of
Money supply. Supply that comes.
Excellent. Are we using real or nominal GDP? Real or nominal?
real.
Real or nominal?
Real.
Real. Real GDP times the inflation rate gives you what? You just said it. Nominal GDP. Nominal GDP. Nominal GDP. All right. So where do we want GDP today? Where do policymakers want GDP to grow at? How fast?
Between 2 and 5.
2 and 3.
Long term, you go back basically 60, 70 years, the economy has gone through recessions and has grown on average 3% per year. And when GDP falls below its long run potential, the economy is growing at 2%, or at 1%, what's happening in here? We're not getting 3%, what's happening in the economy? If we're growing below our potential,
We're losing out.
what's happening in the economy? You're an economist, tell me what?
We're stagnant.
You're not stagnant, you're growing below. So let's say you are stagnant. Okay, what's happening in the economy when you're growing below the potential?
It's
No
slowing.
consumption.
What?
There's no consumption.
Low consumption? What else? Think of the definition of GDP. Low consumption?
Domestic product.
What?
Gross domestic product.
Yes, the gross domestic product is growing below its potential. So consumption is lower, what else?
Exports are lower.
Net exports?
The velocity.
Net exports are low. Okay, think about your GDP equation. What else?
No
Money's
velocity
not
of money.
Not yet.
moving. Money's not moving around.
What? Not
Money.
yet. Not yet. We're still stuck on GDP.
Low labor production.
Low labor production. What else?
Leakage in the system.
Let's don't do that yet. What else is low?
Employment participation.
Low employment. Participation. What else?
Productivity.
What else is happening? Happening. Again, don't go to the table yet, because that's not what we're talking about.
Exports go.
We have low and then exports. What are the two other factors in the GDP equation that we're missing?
Government spending.
Government spending. Give me one more.
Investment.
Yep. Low investment. Do we have excess aggregate supply?
No.
If we're growing below our potential, do we have excess aggregate supply? Do we have low aggregate demand? Do we have low aggregate demand or high aggregate demand if we're growing below our potential?
Maybe high demand.
Do we have low aggregate demand or high aggregate demand? Okay, if we're growing below the potential,
High aggregate.
you're saying we have high aggregate demand. what you're saying. If we're growing below our potential, do we have high or low aggregate demand? If we're growing below our potential, do we have high aggregate demand or low aggregate demand? There's only two answers.
What's aggregate?
It's either high or low.
What is that?
Government, investment, employment,
Low.
exports, consumption, low. Okay, so you have low aggregate demand. If you have low aggregate demand, you have high or low aggregate supply.
High.
High aggregate supply. Yeah, if you're growing below the potential, you don't have high aggregate demand, so you're gonna have high aggregate supply. You're gonna have more supply in the market because the demand is low, right? So you can have high, I'm trying to get to something here. It all flows into the equation. If you have high aggregate supply, there's a lot of supply in the marketplace. What's happening? What happens?
The prices go down.
Exactly. Prices go down. Prices go down. And if prices go down, do you have inflation or deflation?
Deflation.
Deflation. When your stocks and bonds and real estate prices go down, is that good?
No.
So if the economy is growing below potential, you're gonna have excess aggregate supply and you're gonna have deflation. Are companies profitable when prices are falling?
No.
No.
Are investors better off when their investment prices are going down? Are banks better off on their balance sheets when prices are going down, the value of their assets are going down? No. So how do you make up for this excess aggregate supply? You gotta increase demand. Okay, how do you do that? So where's GDP? What's our target?
3%.
3%. Where is it currently today?
1%.
Roughly 1.5%. So are we hitting our targets?
No.
No. What about inflation? What's the target for inflation?
3%.
2%. Where's the inflation rate currently today?
1%.
1%. Are we currently hitting our targets?
No.
Okay. Where's the velocity of money today? 6 times. Where was it historically? You can just guess. It's not lower than this. Is at the all-time low. It's never been this low. So you can't go lower. Yeah, it's only around 8 or 9. Are we hitting our targets?
No.
Are we hitting our velocity targets?
No.
What's the money supply growing at right now?
13,
What is it?
13%.
No. Where is it currently?
Yes,
8 to 10%. During the financial crisis, we were growing the money supply at 30%. Okay. What's the problem? Where's the solution?
Grow the economy.
Well, we can't do anything about inflation.
You have to grow the
Have
economy.
more money. Print more money. You have to fix the labor productivity.
Let's get to that in a minute. Let's do the equation first, and then we can talk about the solutions. Can we grow the money supply?
Yes.
And what would be your recommendation? To get to a 3%, what would be your recommendation? To the Federal Reserve, you're sitting on the Open Market Committee. You're using quantity theory of money as a policy tool. What would be your recommendation to Janet?
Print more money.
Janet wants a 3% GDP growth rate. Can't really affect inflation, there's really no inflation. So what would you do? Can you fix velocity? Can the Federal Reserve fix velocity?
No?
Not really.
No, in the short.
Let's do what they can do first, okay? So what can the Federal Reserve do to get to 3%? Print more money. Right? Print more money and increase the money supply. Are they doing that?
No.
No, they're not. So we're getting low GDP growth rates, well below the potential. So we're running a risk of what? Inflation. Okay. Has the Federal Reserve printed money already? Yeah, how much? What's on their balance sheet right now? How much money is on the balance sheet? How much money has the Fed printed since 2008?
4.5 trillion.
4.5 trillion. Is that a lot of money?
Yes.
Yeah. Do you think they could print another 5 trillion?
Yes.
They might, but it would probably freak everybody out. Right? It would freak everybody out.
Trillion.
What?
The 0.45 trillion that they have right now, is it backed by like gold or
Bonds. Government bonds, mortgage-backed securities. Paper. Backed by paper. Okay, so can the Fed print more money?
No.
Nope. Is the Fed printing more money? Is the Fed implementing quantitative easing, yes or no?
Yes.
Is it?
Well, they're recommending it.
And now I'm asking you if they are.
No, not right
So
now.
you got no QE. Can't grow the money supply. Inflation really isn't a problem yet. You're growing below potential. What's the long-term solution, Tatiana? What's the long-term solution? What is it? What's the long-term solution? What? Exactly. Increase velocity. To what? To what?
8%.
8-9%. Exactly. Okay. So how do we do it? You're the policymakers, we're now doing, economics. You're all economists now. So how do we increase velocity?
Fix the labor productivity.
Okay. Labor productivity, increase that, what else?
Keep the money inside the country.
What?
Keep the money in the country.
You could regulate. How about regulating shadow banking and hedge funds? What? Could we do that through regulations? Could we keep the money in the economy by creating regulation and not
Yes.
having the money go out overseas?
Yes.
Okay, what else?
Job trainings.
Jobs. Job training. What else?
Very professional people inside the country, don't encourage them from outside.
Maybe a limit. Immigration.
Make investments more appealing.
And that's true. Investment return. When your interest rates are 0 and negative, why would you put it at the bank? When interest rates are 0 and negative, why would you put money at the bank? And if prices are falling, why would you put money at the bank at 0 or negative interest rates? What are you better off doing?
keeping
Real
the house,
estate.
Investing.
buying gold.
We're not going to gold.
Process.
Real estate or
No,
something.
no, no.
Property or land.
No.
Hoarding the
Gold.
cash in your house.
Cash.
To do what?
Aren't I getting a return, a real rate of return? If prices are falling, isn't my cash going up in value? So wouldn't I hold more cash? So if I have higher investment returns, am I gonna hold cash or am I gonna put it into the investments?
You're gonna invest,
You're gonna invest, is that gonna increase velocity?
yes.
Yes. If I get more return from investments, what do I do with the return money?
You spend it.
Spend it and consume, right? So other consumption. Policies around consumption. Policies around investment and savings. Policies that would basically try to get people to not hoard cash. Get the money to go in the economy. What is velocity anyway?
How many times money moves through the economy?
Yeah, the number of times the cash circulates in the economy. So if you can come up with policies that are going to increase velocity, holding inflation and the money supply constant, what happens to GDP?
Goes up.
Goes up. Okay. Is there anything that we're missing in that conversation? Okay, how are we doing on time?
605.
So when you ask for the failures, those are the failures under the monetary policy, right? Because you mark my notes.
This would be considered policy failure, both fiscal and monetary policy failure, in regards to the collapse in velocity. So velocity is currently stuck. Inflation is stuck. If you don't have velocity, if you can't fix velocity, then what do? You get GDP to go to 3%. If velocity is stuck at 6, how do you get GDP to go to 3%? Holding inflation constant. How do I get to the 3%? Holding inflation and the velocity constant. Go ahead, print more money. And if that's your only tool, how much money would you print? And at what rate? How much would you print and at what rate? We already talked about it. 30%. Okay. So that's kind of what I was looking for there. Did I miss anything on that?
No.
Okay. Last one. We will expand on the valuation methods next week, do some research on Goldman Sachs and Bank of America. Read as much as you can. Go to the reports, Morningstar, Standard & Poor's, Value Line, go up to their website, go to their earnings reports, listen to their earnings conference calls, learn everything you can about Goldman Sachs and Bank of America. Is Bank of America big?
Yes.
Yeah, they're huge. How big's Goldman? No, Goldman is not bigger. About half the size. You're still talking about roughly, companies that are trillion, couple $1 trillion less. Is that big? Trillion? Yeah, those are huge companies. Okay, so let's calculate the value of the stock. Okay, this is what you're going to do. So let's start. What's the first step in the valuation process? How many valuation models do we have? 4. What's the first one we're going to use? Perpetuity. Excellent. And what's the perpetuity model?
cash flow.
In this place, we're gonna use earnings per share. Are we gonna use last year's, this year's, or next year's?
Next.
Next year's. Okay, and then what do we do? We divide it by what? The expected return. Or what can the expected return also be called? It's also called what? What? Can you speak up? Discount rate. Okay, discount rate. All right.
Is
And
the-
what is?
Is the earnings per share the same thing as the cash flow?
Yes.
Okay.
Yeah, this model can be used, earnings per share divided by the discount rate, dividends divided by the discount rate. You can use EBITDA, earnings before interest, taxes, depreciation, amortization, per share divided by the discount rate. You can use EBIT divided by the discount rate. You can use net operating income divided by the discount rate. You can do it in aggregate to get the firm level, or you can do it per share to get the value of the share. Okay, so the model is very versatile. It's used a lot to value securities and companies and real estate. So in this case, how do we calculate the earnings per share next year? How do we calculate earnings per share next year? You can pull it out of the area, you can calculate it.
It's the current year divided by the discount.
Is it,
We times that with 1.8,
100.
1.08.
what's the earnings per share? Do we start with the earnings per share next year,
13.
this year, or last year? Next year, this year, or last year?
Next
If I want to calculate next year's, do I use next
We
year's?
should calculate next year's.
Yeah, how do I use it? Do I calculate next year's? and
This
then
year's is 13, we should time that with 1.08.
Excellent.
I think.
So you're gonna take $13, which is last year's earnings per share.
But
And
there
you're
was
gonna-
given 14.
Hold on. What do we multiply it by? What is it? What do we multiply it by? I need next year's earnings per share. What, by what?
1.01,
By what?
1%, so 1.01.
0.8.
I don't know where you're getting it. 8's the expected return. We need to get earnings per share growth rate for next year. So how do I get next year's earnings per share? Do I need to grow out last year's earnings per share to get next year's?
Yeah.
Yes. What do I grow it out by?
The going in,
What do I grow it out by? Growth rates.
So T plus 1.
1%.
And that 0.05.
5%?
By 5%.
Yeah.
1.05. Okay, and what does that give you?
13.65.
13.65.
13.65. Okay, and if I want to round it up,
13.6.
let's just round it up.
13.6?
Let's round it up even more.
14?
Okay, just let's make the math really easy. Okay. Oh, that's what I put down here. All right. Now, what do I do with the $14? What do I do with the $14 to get the value for the perpetuity bond? By what?
Divided
By how much?
by 0.08.
Excellent. So what's 14 divided by 0.08?
175.
Okay. Got it. So we got the first one. Okay, now let's do Gordon Rowe.
14 over
So it's going to be 14 over what?
0.08
Okay.
minus
Okay.
0.01.
Excellent. And that's going to give us what?
147.99.
0.07? Great.
174.
Okay, hold on, I don't want to confuse everything.
Ah,
Okay. So we take the 1.08, we take the going in growth rate, subtract it, we get 0.07. 14 divided by 0.07 is what?
174.
That should be more than this.
200 I got.
What is it?
195, but with 13.65, not with 14.
No, 200, if you divide
It's okay.
14.
14 divided by 0.07
200.
is what? Okay, I'm getting conflicting numbers.
The difference is because of working
Let's
with
just use this
14
one.
or 13.
Let's use 14.
Okay, 200.
200.
I'm not gonna get neurotic about the actual pricing, it's the methodology, okay? So do you understand the methodology? Okay. So we have 200, it's gonna be the value under Gordon Grove. Okay, now let's do the multiple, this one's gonna be a little bit more complex. What's the equation?
13 times 8?
Hold on, give me the equation.
Oh, okay.
Cash
Wait,
flow
what?
times the
So
multiple.
we're gonna use earnings per share,
Yeah.
we're using last year, this year's, and next year's. Next year. Okay, now what? Now what do we do?
Time?
Times what?
And
Times the multiple. Do we want to use last year's, this year's, and next year's? Next year's equals the value using the multiple approach. Okay, what's the earnings per share for next year? What is it? 14. Okay. Now, how many ways can we calculate the multiple?
3.
There's probably a little bit more, but let's go through them. Okay, go ahead. What's the first one?
We can also, 14 times 50.
I don't know.
Sorry?
Okay.
you can use
okay.
perpetuity.
Let's do that one first. Okay, so I gave you one multiple. Okay,
15
so what's
times
14?
14?
And what is that going to give you?
210.
Okay, 210. Okay, give me the other ways to calculate.
1 over 0.08
Okay, and what's that?
times
multiple?
14.
Okay, yeah, so give me the multiple here. Are you guys doing this in your calculators? Okay, what's 1 divided by 0.08? What is it? 1.5. Okay. And what's another way of calculating a multiple?
1 over 0.7.
Exactly, 1 over 0.07.
Yeah.
Okay, and what's the multiple there? What is it? 14? If I take 12.5 and I multiply it by 14, what do I get? I take 12.5 and multiply it by 14, what do I get?
175.
Isn't that the same as the multiple, as the perpetuity? And if I take 14 and multiply it by 14, what do I get? You get the 200. So this model, creating a multiple out of the perpetuity model, gives you the same number. Okay? If you do this calculation, you get the multiple, and multiply it, you're going to get the Gordon Grove. This method and this method are the exact same. This method and this method are the exact same. Why am I making you do that? Because the valuation experts use multiples. They don't use the perpetuity of the Gordon Grove like this, they can calculate it like that. So when you take your finance classes, or entrepreneurship, or new venture capital, or any of that stuff, and you start talking to the valuation and the finance people, and they're talking about what the value of the firm is, they're gonna be using multiples. To figure out the value of the company, they're not gonna be using perpetuity and Gordon Grove.
Does that normally end up equaling out like that?
Yep.
So it's really just.
This times this is that. This times that is that. That's the way it is. Some industries use this. Finance industry uses this. It's culture. Okay. So I wanted you to just kind of walk through and see if you understood how to how to calculate some multiples. Because what you're gonna do is you're gonna go out and you're gonna find price to earnings per share. Is that also a multiple? The price of the stock divided by the earnings per share? Does that also give you a multiple?
Yes.
Yes, it does. And what you're gonna do is you're gonna look at the PE multiple for Goldman and B of A over the last year. You're gonna look at the price to earnings multiples for the peer group, and you're gonna see that there's a range. And you just multiply the range of multiples by your earnings per share estimates, and you're gonna get a range of valuations using the multiple approach. You're gonna come up with a range of expected returns. You're gonna apply the perpetuity model, you're gonna get a range of valuations. You're going to use a range of growth rates and maybe expected returns, and you're gonna get a range of values using Gordon growth. You're gonna come up with a range of multiples, apply it by the next year's earnings per share, you're gonna get a range of valuations. And then the discounted cash flow, you'll do the same. So from the different methods, you'll have a range of values. And you'll probably pick the midpoint from the four. And then you weight them to get the weighted averages. Okay. So last one, discounted cash flow. How much time we got?
619.
How much time? 20
Um,
minutes?
yeah.
I just need to time this. Last one. You guys are the team, the investment banking team, the finance team. You've been asked to value the company's stock using the discounted cash flow model. Here are your assumptions. I'm the board of directors, investment committee, client. Walk me through the discounted cash flow model, please.
13 over 1.
What do we do?
13 over
Okay.
13 over 1.08.
Okay.
No,
And what's-
over, not time. Yeah. Like 13 divided by 1.08 plus
Okay.
13 times 1.01 times 1.01, yeah, over,
Okay, is this right? Let's start over again. Okay, walk me through.
I'm working with 13.65 as the last one.
Okay, well, you can just recalculate it while we go.
Okay, 14 on
Okay, so we grow out to the, okay,
yeah on 1.08 with the power of 1. Yeah, that would be.
that,
No. On the one with on the yeah
okay,
with the power of 1, which is
got it,
plus 14
okay,
times
go ahead,
105.
okay,
Yeah, on 1.08 with the power of 2.
okay, what's here?
14 times 105. You should. There is no 105 there.
Okay,
Yeah, it is. The 14 is already grown. So
14.7.
like that? Yeah, so I have to grow it out another 5%?
yeah.
Yep, okay. And next? Now what do I do?
Grow that one with 5%. Another 5%.
Is it 5 or 4?
Oh, 4. Yeah.
Okay, and what's 14.7 times 1.04?
15.3.
Okay, now what?
1.08 with the power of 3.
Okay,
3%.
Okay. What does that give us?
15.8.
Okay. Okay, now what?
2%.
Okay,
16.1.
okay. Okay, now what do we do?
Yeah, and grow that with 1% plus terminal value.
Do I add it? What do I do?
Yeah.
I'm gonna do this. Do I grow that up?
Yeah.
Okay, what do I get? Okay. Do I do that?
No. Terminal value.
You're right. And then what do we use? What are we trying to calculate now from this?
Yeah.
The terminal value? Okay, and how do we come up with the terminal value? Okay, what are we gonna use? Thank you. 1 minus 0.01, what does that give us?
This is 0.9.
0.09, what's 16.3 divided by 0.09?
181. 181.1.
Okay. What do I do with that?
Added to fifth year.
Okay. And what do I get?
197.
197? All right. Now what do I do? What am I trying to calculate here? Present value. Okay. Now what do I do?
Now you calculate.
What are these called? What are these called?
Discounted rate.
Discount factors. Okay, now you need to calculate the discount factors. So calculate the discount factors. So give me the discount factors.
Okay. 1.08, 1.166.
Well, just round up.
Okay, 1.2, 1,
Okay.
1.259 will be 1.26. Oh, okay.
Okay, wait, hold on. Are you guys all checking the numbers? Are you doing the calculations? You just round up and make the math easy. 1.808 to the fourth power.
1.36, which is 1.4,
Okay, thank you.
and 1.46, which is 1.5.
1.5?
Yeah.
Okay. Now what do we do? What do we do with the discount factors?
Divide.
You divide?
No, just
Divide?
yeah. Divide the denominator to the denominator.
Okay. So what's 14 divided by 1.08? What's 14 divided by?
12.9.
What's 14.7 divided by 1.2?
12.25.
What's 15.3 divided by 1.3?
11.76.
Just give me one decimal.
Oh,
And what's 15.8 divided by 1.4? And is all this right? Is everybody
Yeah.
correcting it and making sure that, okay.
11.9, 3.
Okay. And what is 197 divided by 1.5?
131.
Now what do we do? Okay, it's 131 plus 11.3 plus 11.8 plus 12.3 plus 12.9.
179, 7, 6, 7. The last number is 151.
This is 197 divided by 1.5 is 131. Okay. We got 179. Is that what everybody gets? And what's the current stock price?
157.
Is the present value greater than the current stock price? What's your recommendation? Can you give me any other recommendations? What other trades? How else can we make money?
5 forwards, 5
Hold on.
futures.
Let's do the stocks first. What kind of stock recommendations would you give? High margin.
Buy margins. Buy call. Right.
If this was Goldman Sachs or Bank of America stock, could we buy a financial services exchange traded fund?
Yeah.
Yeah, and would Bank of America and Goldman Sachs make up a significant portion of that exchange traded fund? So do you think there would be correlation between the financial services exchange traded fund price and Goldman Sachs and Bank of America's stock price?
Yeah.
Do you think they would move together? And if so, what other trades could we do?
We do the same trade.
Do the same trades? Okay. So 1, 2, 3, 4. So if I can do it for the stock and the ETFs, how many total trades can I have? 8. 8 trades. I think I could find stock indexes for financial services companies, indexes. You think I could find those? Could I find financial services stock indexes? Indexes that track financial service companies?
Yes.
Yes. So could we also deploy some other trades on the indexes?
Yes.
Yeah, and what would those trades be? We think
We buy forward.
we think the price is higher than the current stock price, we think the price is gonna go up, don't we? Yep, so what would we do on the indexes?
Buy forwards.
Buy for
Buy forwards.
Buy forwards,
Buy futures. Buy calls on
Futures.
futures.
buy calls on the futures,
Buy puts.
buy puts on the futures,
Yeah, puts on futures.
for a total of how many trades? 12. So when you go do the valuation for Goldman Sachs and for Bank of America, you're gonna come up with this, you're gonna come up with the growth rates, you're gonna come up with the discount rates, you're gonna come up with the terminal values, and you're probably gonna vary these growth rates. You're gonna come up with the growth rates. You're gonna come up with the discount rates. You're gonna have to decide, when calculating the terminal value, is the cash flow is gonna remain constant forever, so you use perpetuity, or do you assume Gordon growth to get the terminal value that you're gonna add back? So the key is gonna be, what are your growth rates and what are your discount rates? you're gonna have to come up with growth, you're gonna have to project out for the next 5 years what you think those earnings per share can do. And how would you do that? How would you be able to forecast the earnings per share over the next 5 years for the companies? How would you do that? What would be the first thing that you would do? You're economists, you can forecast.
You look at what they're currently doing.
Yeah, you look at what they're currently doing, and once you look at what they did before,
Yes.
history, once you look at the trend, and do you think that EPS goes in some kind of cycle? And do you think that there's a correlation between earnings per share and the overall business cycle?
Yes.
Yeah, probably. And if you think we're going into negative interest rates in a recession, do you think that the earnings per share is gonna grow at a rapid rate? Do you think earnings per share is gonna grow at the same rate at the peak
No.
No.
or at the decline? No. So you're gonna have to figure that out. Are they going into an earnings per share decline? Is the growth rate slowing? Is it actually shrinking?
Hi, I'm sorry, we're over. I
Oh,
really
okay.
have to go. I'm sorry. Can I get
That's fine. That's fine.
Sorry.
Okay. That's it. Give me your stuff.
Thank you. Sorry about that.
No, that's fine.